Hi guys, welcome to week 9. Can you believe? So this week, we're going to be looking at a few issues relating to budgets, okay? So without further ado, I will share my screen and we will go from there, okay? So let me just share that. There we go. All right, so accounting for managers, okay? As I said, it's about budgets this week, which are really important for most organizations. And as far as this goes, we want to explain the link between planning and budgeting, help us understand what a budget is and what the key steps are, talk about the different types of budgets, what's a master budget, okay, prepare a schedule of receipts and payments, explain the use of budgeting for planning and control, and also discuss what we call the behavioural aspects of budgeting. Now, strategic planning is about long-term planning. What's our strategy? Where do we want to be in 3 to 5 years? Okay, it's usually carried out by senior management. Okay, it commonly relates to broader issues such as business takeovers, expansion plans, deletion of products, addition of products, capital intensive works and purchases, things like that. Okay, things like that. So there's actually a whole bit to it. Okay, now, all right. So budgeting, that focuses on the short term. How much money we want to make next year, what capital items we want to keep next year, how much cash we're going to need next year, what's our expected profit, okay? So budgeting results in the production of budgets that set the financial framework, something that we aim for or we try to stick to. So it might involve, say, expenditure. Now, we don't want to expend too much. It's not just a free-for-all, okay? But we don't want to have a situation where we don't spend any money at all and lose customer satisfaction because we're using poorer quality materials. So budgets operationalize strategic plans. So the strategic plan could be 3 to 5 years. The budget is just trying to put things into perspective. What do we got to do this year? We prepare a budget so we can meet our targets for next year. And the same goes each year, okay? What do we got to do the year after so that we, again, meet that strategic plan in the long run, okay? The other important thing is it allows each department or each area of the company to understand how what they do contributes to the overall objectives of the organization, okay? Now, oops. So, this is a bit of a diagram and I'll just go through it, okay? Obviously, it's a bit of a cycle here. So the first thing once we prepare a budget is we want to monitor the actual results compared to what the budget said we should do. And then we want to look at what are the differences? Why did we do better or why did we do poorer? We then want to evaluate and reward performance. If people have done what they're meant to, if they've outperformed, we might want to give them a bonus. Each year or each period of time, we reassess the vision and the core competencies. We think about our long-term strategies. We develop operational plans. We translate the strategies into budgets each year, and then it goes on and on and on. So basically, in a simple term, we start with a strategic plan, we turn that into budgets, but then we have to make sure that we're sticking to our budgets, okay? Now, entities engage in a planning process that requires involvement in the budgeting process. Part of the formal planning process relates to an entity's operational plan, i.e., what are our short-term goals and targets? Okay. So performance management is not just about setting targets in financial terms. It can be setting targets in non-financial terms, such as a target to improve customer service, a safer workplace, maybe less staff turnover. Now, a budget is a quantitative expression of an entity's plans. Okay, so it can put into operation longer term plans. You've got to start somewhere. We might have a 10-year plan, but we've got to start somewhere, and we're going to do that with our budgets. Assessing the feasibility of plans, setting targets for managers. What sort of revenue do we want them to generate, perhaps? Identifying resource constraints. You know, we said we want to double sales, but what's the impact of that on production? Will we be able to produce enough given our equipment constraints? Will there be cash shortages or excess cash? Assisting with short-term planning decisions. Do we have enough capacity to expand our operations? Providing profit forecasts and other financial data to the share market, for example. Forecasting data such as sales or fees. You know, what happens if we don't increase our charge for our goods over the next 3 years? Will that product become unprofitable? Helping determine how much inventory we need. And as part of having inventory, we've got to think about what raw materials we'll need. Do we need to hire more people? Okay. And will we be able to pay our bills and meet our financial commitments? Okay. So there's many different types of budgets, okay? Now, we're not going to go through all of them, but we're going to talk about a few of them. So a cash budget is a forecast of estimated cash receipts, cash payments for a period of time. Financial statements represent the past, but budgeting, we're trying to work out what is happening into the future. Now, cash budgets assist with the identification of when commitments are due. Okay, will we have enough cash to pay that bill? If we don't have enough cash, we might end up in the problem where we have what we call liquidity or solvency problems. And if it gets really, really bad, it can lead to bankruptcy. The reason this is important is we need to be able to pay our bills. If debts are not paid on time, the reputation could affect our credit rating. We may not be able to borrow money. Companies may not want to deal with us as a result. Cash budgets are also going to talk about excess funds. So we don't want to have a situation where there's a lot of cash just sitting in a bank account doing nothing. Because we say that cash is a lazy asset. And as a result, it earns a low return. So we've got to say, okay, we're going to have a lot of cash at this time of the year. Can we invest it? Can we use to pay down debt? What can we do with it? Okay. Maybe we can accelerate some of our payments we have to make and maybe get a discount because we've paid early. Cash budgets can also reveal weaknesses in a debt collection policy. Hey, we're making lots of money, we're making lots of profit, but our cash is low. Why? Because we're not very good at collecting the money owed to us. So we might have to take some steps, contacting customers more regularly, telling some customers who don't pay us that we're only going to deal with them on a cash on sale basis. We want to be paid up front. Okay. Cash budget, we can also adjust for seasonal fluctuations. Sometimes you might have a situation where we have a high period and a low period. So let's think about tourism and the ski fields in New South Wales. They're going to have times where they generate a lot of cash during the middle of the year when there's snow, but at the same time, they still have a lot of money that they have to spend during the rest of the year on repairs and maintenance and making things better. They would have a little bit of cash coming in, but not nearly as much. And so therefore, they have to have a cash budget so that they don't use up all the cash they have too quickly and run out of money, okay? And run out of money. So as we said, budgets reveal periods when shortages of funds may occur, and we want to identify them up front so that we can make arrangements with our bank. You tend to find that if you do it up front, you're going to get a better deal than if you're trying to fix a cash shortage problem really, really quickly, okay? So steps may be made to avoid these shortages or to repay overdraft as soon as possible so we don't pay too much interest. Cash budgets are often or sometimes demanded by banks when people apply for a loan. What they're trying to see is, will they have enough cash to meet their commitments? Okay. Now, as I said, budgets are a form of control. We can use them to assist with monitoring employees' work, i.e., if we've got a sales team, are they working hard enough to meet that target, or are they kind of slacking off? Investigations into the difference between actual and budgeted figures can tell us why variances have occurred. Is our legal department failing, or is there a problem with our purchasing? So we often have times where we don't have enough raw materials, and so we have a situation where the machines aren't being used at their full capacity because the purchasing people aren't doing their work properly, okay? So when we prepare a budget, we've got a couple of questions here, and we can do these in our own time. We'll do plenty of questions in our tutorial today, or when we have our tutorial. But if we have a look here, it says, prepare a cash budget for April, May and June from the following information. So for 2013, we're given some information: cash sales, cash purchases, cash expenses, collection from accounts receivable, so that'd be a cash inflow, and payments to accounts payable would be a cash outflow. So you can do this yourself and see if you arrive at the correct answer. Then we have the information for May or June, but we know that we start with $15,000. So what we have our opening balance, we said, was 15,000. And we're going to add some receipts here. We said it was 130,000. Now the 130,000, if I go back just quickly, is from sales and collection of accounts receivable. We have payments of 90. Let's go back, have a quick look. Is equal to cash purchases, expenses. We're going to assume we've paid cash for them. And then the payments of accounts payable. So 60 plus 10 plus 20 is equal to $70,000. Okay. Now, we do this. You'll notice that the balance at the end of 1 month forms the opening balance for our next month. And we do it each year. Now, as you can see by this organization, they're pretty good at generating cash, because after 3 months, they've got a cash balance of 180,000, which is very healthy for a small organization, okay? Cash budget variance report. This is the other thing we can do. Payment to our suppliers. We budgeted for 120 and the actual was 114. So it says 5,500 favorable, but you'd want to look at that. You'd want to think, okay, why did we spend less for our suppliers? Is it going to result in a problem in the future where we have a shortage because we didn't spend enough? Or have we started using cheaper, poorer quality materials? I know it's saving us money in the short term, but when customers are dissatisfied and start bringing back their products and giving us bad reviews for that particular product online, it may become a situation where it actually really, really does count against us, okay? So we're going to have to keep that in mind. So guys, that's a little bit of an insight into budgeting. I'm sure some of you have done your own budgeting in your own time to help understand where your money comes from and where your money goes to. But I just wanted to spend a couple of minutes on that. I hope you enjoyed that particular concept. And I will talk to you next time. In the meantime, have a great day and please attempt the tutorial. Thanks, guys.